How is everybody doing? How is everybody? Today I want to talk about Bitcoin and the wisdom or the lack thereof of investing large sums of money, of your hard-earned money on Bitcoin. I've already done two videos, which I think I did in 2021 or 2022, if I'm not mistaken, about the foolishness of putting money in Bitcoin and why Bitcoin is a very foolish investment instrument to put your hard-earned money on. And so it happens that in the last few weeks, Bitcoin has been doing well in the market, reaching at some point in the last 2 weeks around $123,000. That's that's a substantial amount of money, folks. That's You can actually get a very good one-bedroom condo in somewhere in Texas, say El Paso or Galveston, or even in Dallas. Actually, you can get a very good one-bedroom or even a two-bedroom apartment for that amount of money. Small condo, maybe a duplex, but it can get something substantial for that kind of money. You can even get, that's how much you would normally pay for an entry level McLaren in a place like Texas, for instance. So I think a Range Rover in Texas, you probably pay just a little bit less than that, roughly around 100K. So I'm just showing you in terms of how much you can do with that amount of money. Or with a McLaren, it would probably be a pre-owned McLaren, but entry-level McLaren. Yeah. But so with Bitcoin reaching this crazy valuation, I felt it prudent for me to revisit the issue of the wisdom of buying Bitcoin or putting substantial amounts of money on Bitcoin. I mean, if you're gonna put money that you are willing to lose on Bitcoin, I mean, be my guest. I mean, like, who am I to tell you not to go to Vegas every now and then to try your luck on the slots table and or blackjack or whatever. I mean, but the only thing is that people who go to Vegas, they understand that they are actually gambling. It's not an investment strategy to go to Las Vegas or to go to any casino. You know that you are gambling. So as long as you know that you are gambling, that's fine. I think for me, that's really where my point of departure is, because if you are putting money in Bitcoin and you know that this is a very risky and dangerous instrument, but because there's opportunity for you to make lots of money as you would in a casino, then cheers. Yeah, but there is one argument that I wanted to respond to, in particular, that a lot of the Bitcoin adherents and devotees like to point to when they are defending its veracity and its importance. On the video that I did, I covered a couple of issues. I covered the fact that this high encryption nature of Bitcoin and cryptocurrency in general, and that it's an innovation that is very disruptive, that's going to change people's lives, does not justify how much it's worth. I even went as far as to say that you cannot explain to me why Bitcoin is valued the way that it's valued, because its valuation, it's not based on anything that is rational and tangible and that is quantifiable and measurable. And a lot of the times, the people who defend Bitcoin like to argue that no, it's just basically like demand and supply on the market. Demand supply determines the price. But the problem with this demand and supply determines the price narrative is that it presupposes or it assumes that demand and supply are these mystic magical powers that magically, without any explanation, can determine the price of any commodity or anything that is sold on the market. It assumes we are stupid. It assumes that we don't know that they are, for every demand function that you have, there are inputs that go into constructing it. Even though maybe if you are doing economics one, you won't go into terms of how a demand function is constructed for asset classes of various types or commodity classes or even currencies. But as soon as you get to economics 2 and especially to economics 3, when you become a major in economics, that is when you spend time actually going behind a demand function of any asset class or commodity class, and then you are actually now are supposed to know how a demand function of any asset class or commodity class or any good or services in a market can be constructed, so that when you plot a demand function, which is why demand functions of different goods are not the same and the slope is not the same, and the in terms of they are not high or low. They are not as equally high or equally low, and that is determined by the inputs, the variables that go into constructing a demand curve. And as you know, that the demand curve is normally in this direction, with the supply curve in the other direction, and where they meet, that's where the market price is. So when you take out a demand curve, which it might not necessarily be a straight line, it might be in real life, it might not be a straight line, but assume it's a straight line. Not all goods or services or commodities or asset classes would have that demand curve being at the same slope, for instance, and not be at the same position on the XY plane in terms of how high or how low it is. And all of those things are determined by the inputs that go into what determines this demand function of this particular good, which is something that can be reasonably and with reasonable ease be constructed if you understand economics. And the argument that we normally make is that the people who say, no, it's demand and supply, they can't construct for us a demand function for Bitcoin, because the demand function for Bitcoin is not based on anything that is rational and anything that is tangible and measurable. And then when we go to the supply side of Bitcoin, things become even a lot more crazy and cool and like cuckoo's nest kind of situation, because the supply side of Bitcoin is where the big mess is. And there's a big argument that these people like to rely on, which is the argument of stock to flow of a commodity. And they're saying that that based on the laws of stock to flow, Bitcoin is worth what it is worth, which is to say, based on, they're always trying to borrow acceptable economic theory to justify why Bitcoin is worth what it's worth. But the problem, as in most things, is always in the details, my friends. Yeah, the problem is always in the details. And what are the details? We'll start by saying, what is this stock to flow thing? Let's define it first, what it is, so that everyone will understand. Because I don't assume that everyone has had some economic training or sort of know what these things are. Stock to flow is a tool that helps measure how scarce a commodity is. It is calculated by taking the existing amount of a commodity, the stock, and dividing it by the additional amount of the commodity produced over the year, which is the flow. So you take the stock and you divide it by the flow. And the stock is what is available currently in the market in terms of that commodity. And the flow, or you can think of it as the flow rate or production rate, is in terms of how much of that commodity is being produced over the year. I can make an example by saying that people can understand of, say, cocoa, which is a commodity that is important for various industries, one of which being the chocolate industry. And cocoa then gets traded in the stock markets, cocoa futures and other financial instruments that trade cocoa. And at a particular given point in time, one could get an exact figure of how much cocoa is available in the trading market globally where cocoa is being traded. It might not be an exact figure, but it will be approximate, but close enough to be reliable to be used. And once we have that amount of how much cocoa is available in the market, which will be the stock under the stock flow doctrine, then at that point, then we can also come up with reasonable accuracy in terms of how much cocoa from the cocoa producing nations is being currently produced per year, whether it's tons per day, or then you say tons per month, or then tons per year. You can have that figure within reasonable ease. And here's the thing. The value in which cocoa then gets traded in terms of the price that it gets to be asked for in the market is affected, among other things, by how much cocoa is available in the market and how much cocoa is being produced. And if there is not enough cocoa being produced, what that does is that it has an upward pressure on the price on the available cocoa that is available in the market. If, for instance, there is a natural disaster in the countries, in say 70% of the countries that are producing cocoa in the world, and we know within certainty that they would not be able to produce cocoa for at least 18 months to 24 months, what that will happen is that we will see cocoa prices going through the roof. And that's because of the stock to flow doctrine. Also, the other side is true as well. If for some whatever reason there is all of a sudden an excess of cocoa being produced, more than it was normally produced in the past few years, year on year, that will tend to have a downward pressure on the price of this particular commodity. Are you with me? So these folks then argue that because Bitcoins have a certain limited number of coins that will be mined in total, beyond which there won't be any more Bitcoins, which, by the way, is also goes into the issue of stock to flow, but also of fixed supply. Every commodity that has a high stock to flow value, but also has a fixed supply, tends to be very, very expensive. that is often certain precious minerals that are very, very, very rare, and it makes it very, very, very expensive because of those two things: stock to flow ratio, and the issue of having the scarcity that is being affected by the fact that a commodity has a fixed supply. Now that I've used the example of cocoa, let me go back now and use an example of, say, oil. Or let me go use the value of gold. We know within a certain level of accuracy, depending on how accurate you want to report matters, that how much gold has been produced in the world and is available in the world right now. That is the stock. And we also know how much gold is being produced per year. And the stock to flow ratio for gold currently is actually 62, which means that it will take 62 years at the rate in which gold is being produced to double the quantity of gold that exists in the world right now. Gold also, in particular, has within certain levels of accuracy can be considered as a fixed supply commodity. Even though it is very possible that at any given moment, someone somewhere in Africa could discover some large gold deposits that have previously not been known, unexploited, unknown, and that will actually add the more gold that is available to be exploited in the market. This happens, it doesn't happen often for gold, diamonds, platinum, and all of those things. So most of these precious metals would, within certain limitations, be considered having a high stock to flow ratio, but also considered as fixed supply, even though they are not entirely fixed supply like Bitcoin. And so I hope now that I've explained what this concept is, so that people will understand why this thing is important when I'm talking about Bitcoin later. But the important thing now that I want to discuss, which I'm going to discuss in the next video, is the example of oil. Because oil and gas are which also in many ways do have a big value of, for what you call it, a stock to ratio, and are also tentatively considered as fixed supply, have this sort of behavior that we see among commodities with this sort of high stock to flow ratio and fixed supply. But unlike gold, oil behaves a lot more like Bitcoin. And I want to explain the issue of oil and to show how it is similar to Bitcoin, and number one, and number two, how it is dissimilar to Bitcoin, so that a viewer can see why the value of Bitcoin is purely based on manipulated price, not on actually intrinsic value. It is a purely artificially created value. I will explain this in the next video. And the reason why I'm saying I'm gonna explain it in the next video, because I'm looking at the time of this video right now. We've already reached the point of 19 minutes. And if I continue any further than this, now this video is gonna end up being 45 minutes, and I don't want that. So So, but in order for you to understand what has been covered in this video, you also need to watch the following video, which I'm going to post. Yeah, so thanks, folks. See you on the next one.